Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today I want us to solve a past paper question on the statement of cash flows, on how to prepare the statement of cash flows in line with the International Accounting Standards 7. Now, if you want to know the process, the theory, the mechanics of preparing the statement of cash flows, we have a video still in our channel that is titled Preparation of the Statement of Cash Flows. We have a video called Preparation of the Statement of Cash Flows. And if you study that video, you will be able to easily follow us because we will follow the procedures. Alright, saying I've taught this course for the last 16 years, and for that reason, I'm able to give instructions which you can never get in any textbook to help you do these kind of questions. So today, I want us to do a question that is November 2016, question 3B, CPA 1, November 2016, question 3B, November 2016, question 3B, and I will follow the advice given within the video I've referred to. Now, if you look at this question, a number of things come into play. We are told Tahiti, the following are the financial statements of Tahiti. Limited. The statement of financial position is given property, plant, and equipment. And as you look at the question, the most important thing is, first of all, ask yourself, what are you supposed to do? And you start with the adjustments. You first of all start with the adjustments as given. You start with the adjustments as given in the question. You start that. So you're supposed to prepare the statement of cash flows in accordance with International Accounting Standard 7 as at the end of 31st of October 2016. And therefore, we go straight to the additional information. The first thing is to do the workings within the additional information and then follow the order. Given within our other video. So we are told, additional information number 1, we are told, 5,000 ordinary shares of shillings 10 each were issued during the year at a price of 12 per share. So if we go to the ordinary share capital account, remember what we said, you always reconstruct your account. Balance brought down, ordinary share capital and share premium was, ordinary share capital and share premium was 150, and balance carried down, it was 200 and 160. Now, definitely the closing balance is usually higher than the other side. So this is 360, this is 360, and therefore you can say we are issuing more shares at 60. And that's what we are being told. We are being told additional information number 1. We are issuing 5,000 shares. At 12 shillings each, and therefore they are giving us 60 million. And this is financing activity. Additional information number 2, you are told fittings and fixtures which had an original cost of 85 million and a net book value of 45 million were sold for 32 million shillings during the year. Now, if you look at additional information number 4, you are told the following information tangible, non-current assets. Fixtures and fittings are tangible, non-current assets. So we say NCA. Remember, these are workings. You don't need to waste a lot of time capturing details in full. NCA, if you look at additional information number 4, we are told the balance brought down is 595, and balance carried down is 720. Balance carried down is 720. And you are told, please mark this. Anytime you're given the original cost and the accumulated depreciation, you reconstruct the asset account and you reconstruct the depreciation account. The asset account will give you the disposals or additions, and the accumulated depreciation account will help you to get the charge for the year. It will help you to get the charge for the year. So we get the non-current asset account and accumulated depreciation, non-current asset account. Non-current asset account. The accumulated depreciation, non-current asset account. Balance brought down is 2290. Balance brought down is 290, and balance carried down, additional information number 4, is 340. It is 340. It's very, very, very important. Please mark this. When you are given your non-current assets at net book value, you use the non-current asset account, capturing the figures at their net current, their net book value. But now when you are given the two, you are given both. If you look at the question number 4, by the way, the past papers are easily available. You can easily download the past papers online. If you just go and you say KASNEB Financial Accounting CPA 1 Financial Accounting past papers, you'll be able to download them. So you'll be able to get the question we are talking about, November 2016 question 3B. So we prepare the two accounts, and then we start capturing the information that we are being given. We are told fixtures and fittings. We know that fixtures and fittings are part of non-current assets. Fixtures and fittings, which are the original cost, we had bought them at 85. So we're not talking about the net book value, we're talking about the original purchase cost. So we are taking it, fixtures and fittings, we are removing them. We are removing them from non-current asset account. They had been bought at 85. So we remove it at 85 because even this we captured it at original purchase cost. And we come here and we say fixtures and fittings account. So we transfer to the disposal account. Fixtures and fittings disposal account. So we bring this to here, 85. It is coming from fixtures and fittings account. But we are told that the original cost was 85 million and the net book value was 45. If you get original purchase cost 85, you subtract 45, you get 40. And therefore you are being told it had depreciation. It had depreciated to the level of 40. And that depreciation, you need to go to the accumulated depreciation account and you remove it from there. The 40, and you say fixtures and fittings. We are not only removing, we remove fixtures and fittings from non-current assets to the disposal account. We also remove its accumulated depreciation from the accumulated depreciation account to the disposal account. We debit the disposal account with the original purchase cost, and we credit it with the accumulated depreciation up to the point of disposal. Now the debit minus the credit gives you the net book value, which we are saying it is 45. The question tells you very clearly that the net book value is 45. Then we are told we are selling it for 32 million. So we debit bank and we credit disposal. We debit bank and we credit disposal. What? Disposal. So you add both sides. This one tells you this is 85 And this one tells you 85 minus 72, 85 minus 72, we get a figure of 13. We get a figure of 13. What are we saying? What are we saying? This, we are taking to P&L account 85. We are saying we bought the fixtures at 85, we depreciated 40, and therefore we are left with 45. But instead of selling it at 45, we sold it at 32. And therefore we sold it at a loss of 13. This is a loss. This is a what?
A loss.
A loss. A loss, and a loss is an adjusting item. It is an adjusting item. It is an adjusting item because we deducted the income statement and it didn't result in a cash outflow. Now we will add it back. 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 Now, if you look at that, you will realize there is no other point. There's nothing else that affects this account. There is nothing else that affects the non-current asset account. There is nothing else that affects the non-current asset account. But please, never forget. Anytime you are dealing with the non-current account, you must check whether there was a revaluation. You must check whether there was a revaluation. And if you look at our question, the revaluation reserve is moving from 91 to 100. Our revaluation account, if you say our revaluation account, if you always remember, when you are working on the non-current assets, check at the financing to check whether there was a movement in revaluation. So our opening balance of revaluation account, the balance brought down for revaluation is 91, and the balance carried down is 100. The balance carried down is 100, meaning it has increased. Our revaluation has increased. Our revaluation has increased, and therefore we take it to non-current. We are revaluing our non-current assets upward with 9. We are revaluing our non-current assets with 9. So we come here and we debit it with 9, and we say it is coming from our revaluation account. It is coming from our revaluation account. And therefore, if we add this and this, if we add those two, we will say we have 85 plus 720. We are having a figure of 805. We get total as 805. If you now subtract 595, and you subtract 9, you realize that we have done purchases amounting to 201, 805, and we are saying we are receiving through bank. We are buying that year. We bought non-current assets amounting to 201. We bought non-current assets amounting to 201. That becomes the balancing figure. It becomes the balancing what? Figure. It becomes the balancing figure. And this is an investing activity. This is an investing activity. Remember, we say that anything that relates to non-current assets is an investing activity. It is an investing activity. It is an investing what? Activity. Now we come to the accumulated depreciation, and we say at the beginning we had 290, we disposed 40, and we had a balance of 340. So we have total on this side is 380, and therefore this side is 380, and therefore we get the charge for the year. We get the charge for the what? For the year. We get the charge for the year, and we are saying it is 380 minus 290. We get a figure of 90. Get a figure of what? 90. That is the accumulated depreciation that was charged in the income statement. And therefore, because we deducted and there was no cash outflow, we add it back. We do what? We add it back. And therefore, we are progressing. These are marks. These are what? Marks. These are marks. I like saying these are, I consider it to be free marks. Because it is very, 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 very simple. Now from there, we are told additional information number 3. The proceeds of sale of long-term investment. When we talk about long-term investment, we are talking about non-current asset called long-term investment. The proceeds of sale of long-term investments amounted to 30 million. So if we long-term investment, you go to the non-current assets and you find out the long-term investments. So we say at the non-current assets, we have an account called investments. We have an account called what? Investments. And therefore, the balance brought down at the beginning of the period for long-term investment is 25. It is 25. And the balance carried down is 0. The balance carried down in what?
0.
Is 0. But we are told we sold this investment at 30 million shillings. We sold this investment at 30 million shillings. These are shillings in millions. These are shillings in millions. Shillings in millions. We sold it. We had an investment at the beginning of the year worth 25 million, but we received the money. We received money through bank, amounting to what?
30.
To 30. And therefore, there is a gain on disposal which we are taking to P&L account. This is a gain. This is a what?
A gain.
This is a gain. That's a million. That's a million. It therefore means we added in our income statement, we had added 5 million as an income. But there was no cash inflow. There was no cash inflow. And because we added in the adjustments, we will subtract 5 million. In the adjustments, we will you must always ask yourself if it's a depreciation or if it's a gain or if it is a loss. What did we do in the income statement? If we added, we subtract as an adjustment. If we subtracted, we add as an adjustment. We add as a what?
Adjustment.
As an adjustment. Now, we are through with our additional information. We are through with our additional information. Now, once we are through with our additional information, remember the arrangements and how to solve a statement of cash flows as explained in my other video. See, there is a video called Preparation of Statement of Cash Flows in line with IAS 7. I have explained the order very well. After you are through with the adjustments, now that you know the adjustments are there, you go back. I said you go back. And you start from your income statement, deducing the information given. Then you come to the balance sheet from the non-current assets all the way to your loans. So we now follow the order. We go to the income statement. If you look at that income statement, there is something very, very interesting. There is something called interest income. We have sales, cost of sales, gross profit, interest income. Interest income. Now, anytime you find interest income, you must ask yourself, where is this interest income coming from? Is it coming from short-term investments or is it coming from long-term investments? Now, the short-term investments are the investments listed above bank. They're the investments listed above bank, and the long-term investments are listed under non-current assets. You must determine where is it coming from, because that income is, if it is coming from non-current assets, then it is not an operating income, it is an investing income. It is not an operating income, it's an investing income. So it is taken to the investing activities. And therefore, if you are getting profit after tax, and you have added investing income, which is from non-current assets, you need to adjust and remove it, and you add it under the investing activities. You add it under investing activities. I repeat again. If you look at the question, for instance, if our question did not have short-term investment, we would automatically know that the interest income is coming from long-term investment, the non-current investments. And if it is non-current investment, anything non-current goes to investing activities. And therefore, it will be shown as a cash inflow. It will be shown as a cash inflow through the investing activities, through investing activities. But this particular question, we will assume that it is coming from the current asset, the short-term investment, and therefore it is an investing activity. It is therefore an investing activity. It is therefore an investing activity. Then you go and you get your interest paid. You can see we are being given very clear in that question, interest paid. And therefore, if you go to the current liabilities, you will not have interest payable anywhere. You don't have interest payable anywhere. That tells you you do not reconstruct the interest payable account. I told you once you've given the income statement, it helps you to reconstruct three very, very important accounts: the interest account, the tax account, and the proposed dividend. So you find you are going back to current liabilities. If you find that there is opening and closing balance of any of them, you are being told to reconstruct those accounts. You are being told to reconstruct those accounts, and if you are reconstructing them, you cannot use them as part of the working capital changes. You cannot use them as part of the working capital changes. And therefore, in this particular case, we have two accounts. We have tax payable and proposed dividend. So we have our tax account, and we have our dividend what? Our dividend account. We have our dividend what? Account. So our tax account, balance brought down for tax account, corporation tax is 110 and 120. 110 and 120. 110 and 120. 110 and 120. And therefore, if you look at it, I'm getting them from the balance sheet. I'm getting that from the balance sheet. You get the closing balance for 2015, it is 110, and the closing balance for 2016 is 120. Then you go to the income statement to get the charge for the year. Tax paid, charge for the year is 110. Tax paid, charge for the year is 110. So you come here and you say P&L account 110. Tax paid is 140. And therefore, you add them, 140 plus 110, 140 plus 110, you get 250. You get 250. And therefore, we are saying, how much do we pay? From 250, we had a balance of 120. And therefore, we paid 130. What are we saying here? We are saying, from the balance sheet, you can get the opening balance of tax liability is 110, and our charge, as shown in the income statement, is 140. That's what the income statement is, our income tax expense. And therefore, the total tax liability, which we had incurred, was 250. But instead of the balance being 250, the balance is 120, meaning we had reduced our 250 with 130 through payment. You do the same with the dividend account. And from the balance sheet, tax 120, 110, or 20, 110, 140. Yes, from the balance sheet, for the dividends, we say 80 and 100. Balance brought down is 80, and balance carried down is 100. 80 and 100. And if you now got, that's from the balance sheet. You get the opening and closing balances in the balance sheet. The opening at the beginning of the year and the end at the end of the year. 2015, you get the opening. 2016, you get the closing. Then you ask yourself, what was charged in the course of the year? In the course of the year, our dividends from the income statement, our dividends that we paid was 100. We paid dividends of 100, and therefore that is a charge for the year. That's a charge for the year. That is what we agreed to pay. So we had a liability of 80. We agreed to pay 100. Total liability becomes 180. But at the end of the year, instead of having 180, we have 100. Meaning we have paid through bank. You have paid through bank an amount of 80. Giving us a balance of 180. Giving us a balance of what? 180. Now we are moving step by step. We are moving step by what? We are moving step by step. So we are through with the whatever adjustments we needed from the income statement, And once you are through with the income statement adjustments, now you go to the balance sheet and you follow step by step. You go to balance sheet and you follow step by step. Some of them, you realize you did the workings when you are working on the adjustments, and therefore you don't have to repeat. For instance, we have dealt with property, plant, and equipment. We have done it here. We have dealt with, we have not dealt with intangible assets. We have not dealt with what? Intangible assets. Now, we have no information of any changes on intangible assets. We have no information of any changes and additional information of intangible assets. And therefore, we say our balance brought down, the opening balance of the intangible assets, was 200, and the balance carried down is 250. Balance carried down is what? 250. And therefore, we are increasing. We had 200 and it is increasing to 250. So we must have bought intangible assets through what? Through bank. You must have bought through bank. Now, this is an increase. This is an increase of intangible assets, and it is an investment activity. This is a what?
An investment.
It is an investing activity. It's an investing activities. We are buying intangible assets. So we go through the whole balance sheet step by step. Step by what?
Step.
Picking everything. Now we have dealt with PPE. We have now dealt with intangible assets. We dealt with investments account. We dealt with the investment account here. We dealt with the investment account there. And therefore we now go to the current assets. You got the current what? We know they are used to prepare the PPE movement. They are used to prepare the working capital changes. They are used to prepare the working capital changes. And also the current liabilities are also used to prepare the working capital changes. Never forget, like we studied in the previous video, the short-term investments above either cash or bank are cash equivalents. And we are tracing, when we are preparing the statement of cash flows, we are tracing the movement of our cash and our cash equivalents. So we add three things to get the opening, cash and cash equivalents. We add the cash, we add the bank, we subtract bank overdraft. Both at the beginning and at the end to get the opening and closing cash and cash equivalent. And therefore, when we are doing working capital changes, we do not take the difference for the short-term investments, cash and a bank, and even under the liabilities, the current liabilities, the ones we have done the workings, like tax and dividends, we do not use them under working capital changes. We do not use them under working capital changes. It's only the remaining liabilities that we use them under working capital changes. And therefore, I will leave that at that. I will leave the current assets and current liabilities that way to use them under working capital changes. So we go to the financing. We go to the what? The financing. And again, share premium and share capital, we have already dealt with them here. We have already dealt with them here. This is only share capital and share premium. This is only share capital and share premium. We combine them together. We have dealt with the revaluation reserve when we were computing the non-current assets here. We've dealt with the revaluation reserve account, and therefore the only remaining account there is revenue reserve. And we know that the revenue reserve, it is the retained earnings account. It's the retained earnings account, and we are basically being told that it increased with 60, from 100 to 60, and it is increasing with 60 because from our income statement, we retained 60 million shillings. We retained 60 million shillings, and then you go to long-term liabilities. Long-term liabilities, and you can see long-term liabilities, it is increasing from 50 to 170. It is increasing by 120, and therefore it is a cash inflow. It is increasing by 120, and therefore it is a cash inflow. Now, once you do that, you prepare your statement of cash flows. You prepare your statement of what?
Cash flow.
You prepare your statement of cash flows, and I want us to prepare it very, very, very slowly. I want us to prepare it very, very slowly so that we are sure that we are getting everything 100%. And therefore, we come and we say our Tahidi Limited, statement of what? Statement of cash flows. Statement of cash flows. And we are saying is, we are getting it for the year ended 31st of October, for the year ended 31st of October 2016. Now, at times, some students do not even know whether to say as at 31st of October or for the year ended 31st of October. Look at the question. The question will tell you whether it is as at or is it for the year ended or it is for the year ended. And therefore, we get our profit before tax. We get our profit before tax. We get our profit before tax, which is from the income statement, it is for 300. We say profit before tax. Profit before tax is how much? 300 shillings in millions. Shillings in millions, 300, it is 300. And then we say adjustments. We say what?
Adjustments.
We say adjustments. We say adjustments. We say adjustments. I want to repeat again. If, never forget this, if the tax which we incurred in the income statement, the tax we deducted in the income statement, or the interest we deducted in the income statement is not the actual cash outflow, is not what we paid, we always either say profit before interest and taxes. Profit before interest and taxes, or we come and we deduct our tax here, our interest here, So in our case, we get our adjustments, and one of them is the disposal of, this is loss on disposal on fixtures and fittings, loss on disposal, fixtures and fittings. We deduct in the income statement, we deducted, and therefore we add it back. We do what?
We add it back.
We add it back. Then we have a gain on disposal. Because we had added it as an income, we subtract gain on disposal. Gain on disposal of our investment. Gain on disposal of our investment is 5. Gain on disposal of investment. Gain on disposal of investment, it's 5. It is a 5. Then we talk about depreciation. We talk about depreciation of non-current assets, and we say that the charge for the year is 90. The charge for the year is 90. Definitely here, you always ask yourself, what did we do in the income statement? When it is a loss in the income statement, we deducted, so we add. When it is a gain in the income statement, we added, and therefore we subtract. Now, depreciation charge of 90, depreciation charge of 90, we had subtracted, so we add. We had subtracted, so we add, and our items are 3, that way. 13 plus 90 minus 5. 13 plus 90 minus 5, we get a figure of 98. We get a figure of 98. 13 plus 90 minus 5, we get a figure of what?
98.
98. We write it there, 98. And because this positive we add to 300, we get 398. We get 398 as profit after adjustments, or working cash flow before working capital changes. Before working capital changes, our cash flow before working capital changes And we then go to working capital changes. Working capital changes. Working capital changes. Remember the video. Remember the video that gives us the process. So we look at the current assets. Inventories are increasing from 102 to 150. Inventories are increasing from 102 to 150, resulting to an increase of 48. Increase in inventory is like we are buying inventory. Increase in inventory is like we are buying inventory and we are increasing with 48. Increase in inventory by 48. It's like we bought inventory and therefore it's an application of cash. It is an application of cash. It is negative. Cash left to the organization. Then receivables moved from 315 to 390. 315 to 390. 315 to 390, giving us 75. Increase in receivables. Increase in receivables. Increase in receivables amounting to what? To 75. Amounting to 75. Again, because it's an increase, it's like we sold on credit and people are having our money. So it's like it is like a cash outflow. It's a cash outflow. Now, from the current assets, I say the short-term investment and cash in hand, you do not capture them at the working capital changes because they give you the cash and the cash equivalent at the beginning once you add the bank overdraft. So from there, we go to current liabilities again. Trade payables are rising from 119, and are getting to, trade payables are getting from 119 to 127, and they're increasing with 8. They're increasing with 8. And therefore, it's like somebody is giving us money. It's like somebody is giving us money. So increase in trade payables. Increase. It's like somebody is giving us money. And therefore, we say that the rule for current assets is the opposite for the current liabilities. And the current liability rules is the opposite of current assets. And at the current liabilities, we only have trade payables because bank overdraft will be used to get the opening cash and cash equivalent, and tax and dividends, we use them. We used them here, so you don't use them again when you are dealing with working capital changes. You don't use them again when you are dealing with working capital what? Changes. So you add them, you say 48 plus 75, and both of them are negative, minus 48, minus 75, you get minus 123, you add 8, you get a figure of minus 115. You get minus 115. You get minus what? 115. So you bracket it, and we get the cash flow after working capital changes. Cash flow after what? Working capital changes. Working capital changes. You get cash flow after working capital changes. So 398 minus 115, 398 minus 115, we get a figure of 283. You get a figure of 283. But we know we have tax that we paid. So we say less tax paid. Less what? Less tax paid. And we know we worked our tax account here. And it said that the tax that was paid is not 140. As shown in the income statement, the tax paid is 130. And this is bank. This is bank. Tax bank 130. So if we subtract 130, 283 minus 130, we get a figure of 153. We get a figure of what?
153. Now,
153 is our net cash flow from operating activities. Is our net cash flow from operating what? Activities. Net cash flow from operating activities. From there, we prepare the cash flow from investing activities. Cash flow from investing what?
Activities.
Investing activities, like we said, is everything that relates to non-current assets. Non-current assets, be they PPE, that is tangible or intangible. So if you come here and you say non-current asset, we say we acquired non-current asset through bank or 205, 201, acquisition of non-current assets. And never forget, we do it on the inside. We record it on the inside so that the total will bring it here. The total will bring it there. Then we also sold fixtures and fittings. We sold fixtures and fittings at 32. Disposal of fixtures and fittings. Now, acquisition is a cash outflow, but disposal is a cash inflow. The cash outflow you bracket, cash inflow you don't bracket. Then, if you go up, you look at our intangible assets. Our intangible assets, we disposed our intangible assets here. Investments, we disposed our investments. Investment disposal. Investment disposal gave us money amounting to 30 million. This is a cash inflow. This is a cash what? A cash inflow. This is a cash inflow. We disposed our long-term investments with 30 million. We also purchased intangible assets. We also purchased intangible assets, which we also purchased intangible assets that we called what? They actually, in the question, they are referred to as intangible assets. Intangible assets. So purchase of intangible assets. Purchase of what?
Intangible assets.
Intangible assets. And we are saying we purchased amount to 50. And therefore, it is a cash outflow. It's a cash what?
Outflow.
It's cash outflow. And from the 4, we say we have positive 62 minus 201 minus 50. We get a net cash flow of 189. We get a net cash flow of 189, and it is negative. And it is what?
Negative.
It is negative, and that is net cash flow from investing activities. Net cash flow from investing what? Activities. From there, we go to cash flow from financing activities. Cash flows from financing activities. Cash flow from financing activities. And again, we look at it. Short-term, long-term sources of funds. We look at what happens with our long-term sources of what? Funds. We say long-term sources of funds. We talk about the shares and the dividends paid. We talk about loans, long-term loans. So what did we do? Did we have any money? Yes, we sold shares. We sold shares. Our sale of shares, 60 million. Sale of shares amounting to what? 60 million. It's a cash inflow. We received the money. And we say that our non-current liabilities moved from 50 to 170. Our non-current liabilities moved from 50 to 170. Long-term debt, and therefore we say it increased with 120. We got more loans. Sale of debentures or long-term loans amounting to 120. We got money. We got what? We got money. But we also said we paid dividend. We paid what?
Dividend.
You must remember that if we talk about the debentures or we talk about shares, if we pay interest and we are very sure that the interest that was paid related to debentures, we bring that interest payment to financing activities. So we also pay dividend amounting to 80. Dividend payment amounting to 80. These are cash outflow. You add all the three and you get the total cash outflow, the net cash flow from financing activities. So 60 plus 120 minus 80, you get a figure of 100. And this is positive 100. This is positive 100. And we are saying that is net cash flow. That is net cash flow from what? Cash flow from financing activities. From financing activities. And we now add all the nets. Positive 153 minus 189 and positive 100. So positive 153 minus 189 plus 100, you get a figure of positive 64. So what are we saying here? Ladies and gentlemen? Here we are now saying that we are assuming that we have not touched the money we had at the beginning of the period. We are not touching the money we had at the beginning of the period, and therefore we are saying cash inflow from operating activities minus cash outflow, we get a net amount of 153. Cash inflow from investing activities minus the cash outflow, we get a net position of minus 189. Cash inflow from financing activities minus cash outflow, we get a positive of 100, and we are getting positive 64 million. And therefore we are saying, because this is positive, we are increasing the money we had at the beginning of the period with 64 million. We're increasing the money we had at the beginning of the period with 64 millions. And therefore, what do we do? We now ask ourselves, what is the money we had at the beginning? What is the cash and cash equivalent that we had at the beginning of the period? What is the cash and cash equivalent that we had at the beginning of the period? And therefore we say, we add cash and cash equivalent. We continue there. So this one we write and say, net increase, because this will increase the money which we had. It will increase the money we had at the beginning of the year. So we say it's a net increase. If it was negative, we will say it's a net decrease. So we say net increase in cash and cash equivalent. In cash and cash what? Equivalent. The cash and cash equivalent were reduced from operations, were actually increased from operation by 153, but out of this 153 we made, some of it was used in the financing of investing. And some of the times you are asked to interpret your cash flow. We're basically saying we made a net cash inflow, a positive cash inflow from operations amounting to 153. And we had a negative 189 from investing activities. We are saying we bought a lot of assets that will help us to generate profits in the future. So this is a good farm. The money we are getting from operations, we are investing it in non-current assets. So we are building our capacity to make profits in the future. So a good bit of this was taken to purchase of non-current assets, but we also acquired more loans. We acquired debentures amounting to 120. We acquired debenture amounting to 120, and we also sold shares amounting to 60. What does that mean? What does that mean? When we acquire non-current liabilities, we are increasing our risk levels. We're increasing our risk levels. We're increasing our risk levels. So we are saying that this figure, because it is positive, it will increase the money we had at the beginning of the year. So this figure plus the money we had at the beginning of the year, because these were the operations, will give us the money we have at the end of the year. So we say add cash and cash equivalent brought down. Whatever we had at the beginning, and we know, if you look at what we had at the beginning from the balance sheet, we have the short-term investment, there was zero. The short-term investment was zero. Plus we had cash amounting to 1 million, and we had bank overdraft amounting to 98. We had a bank overdraft amounting to 98 plus negative 98. And therefore we had 97. We had 97 and all of it is negative. We had 97 and all of it is negative. So 64 minus 97, we get a figure of minus 33. We get a figure of, so this is the closing, this is supposed to be the closing balance. So if we go now to the closing cash, how do we get cash and cash equivalent? At the beginning of the year, you got to the year 2015, our beginning year 2015, and you get the cash, you get the bank, you get short-term investment, and you subtract bank overdraft. Those four things: the cash, bank, short-term investment, and bank overdraft. Never forget that those are the things that make the cash and the cash equivalent. And always the bank overdraft is negative. It reduces what we had in cash and bank and short-term investments. So if you look now at what we had so this is supposed to be cash and cash equivalent carried down. Whatever we carried down at the end of the year, and if you look at the balance sheet, the cash in hand was 2, plus short-term investments amounting to 50, minus bank overdraft amounting to 85, minus 85 minus 52, 85 minus 52, we will get 33. You will get 33. Now when if once you do you add the opening cash and cash equivalent and you find it is 97, and once you add the figure you are getting is the cash and cash equivalent, again you are computing from your balance sheet, and you find they are agreeing, then you did your question right. I want to repeat again. Once you do your workings, you get the figure there, 64. Then from the 64 figure, you add the opening cash and cash equivalent. And I want to repeat, the opening cash and cash equivalent, you go to the column of the balance sheet, the opening balance sheet, you add the bank, you add the cash, you add short-term investment and bank overdraft, you get the opening cash and cash equivalent. Then you go to the closing column, the balance sheet of the closing balance sheet, and you add the same, the cash, the bank, and the short-term investment and bank overdraft. Now, that figure, if you are wrong, if you never did things right, this figure may not agree with the closing cash and cash equivalent from the balance sheet. If they agree the way they are agreeing, it means that the question is well done and you have scored 20 out of 20 marks. Thank you very much. Once again, I want you to subscribe, like, share, and hit the notification bell so that every time we are loading our videos, we are able to inform you. Thank you very much.